Hey,
Morning.
man.
Good morning.
Absolutely. Good morning. Good morning. Happy Sunday, everybody. How we doing? Hope everybody's good. Had a good weekend. Thanks for being here. These Sunday calls are really, I think, the bread and butter of this community moving forward. I really appreciate you guys taking the time to be here with us on a Sunday. Going over the market and really having a clear plan and strategy and being able to work together on more of a group basis, a one-on-one basis, and go over the strategies in detail, I think is going to what's separate us moving forward from not making the same mistakes again. So the whole point of these calls on Sunday, guys, is that one, we can ask questions and get to know each other. Questions that everybody else really has. Most questions that we are going to be, most concepts and strategies we're going to be going over today, I think a lot of people are kind of wondering the same thing. So it gives us an opportunity to go over those, get them solidified in stone, and really practice them in execution style before the market makes a turn. And especially right now with the market being the way it is, guys, just downbeaten and downtrodden. This is really the opportunity that has come along every 4 or 5 years that I've been a part of in the market. And this being my third cycle, I think it's really important that we stay focused and make sure that we are executing with strategy over time. So today, guys, I want to go over altcoins, altcoin entries, execution, and profit timing, especially now. And I think a lot of people, they want to know how to trade. They want to know how to invest. And they're two very, very different things. So we have to separate the two. We have to figure out who we want to be, what we want to be in terms of how we want to strategize around either being a trader or an investor. It's okay to be both, but they're two different strategies. So again, the point of these calls is I want you guys to participate. I want you guys to ask questions. I want you guys to, if there's other topics that we haven't brought up in today's call, there's going to be an opportunity towards the end to go into any other topic, whether it's in the charts, whether it's on-chain analytics, fundamentals, technical analysis, whatever the case may be. So definitely just be ready to participate. Take some notes. We will be live streaming this. But again, if people are watching on live stream, they're not really participating the way that I wish they would. So I want to let you guys know this will be back on the YouTube. And so let's get going. And so first things first, guys, thanks again for being here. If you're not on the mailing list, make sure you email me and I'll put you on the mailing list. So I'm going to send out reminders twice a week for these calls. It's on a Sunday. Weekends can be busy. Sunday morning's not always easy to make, especially if it's on the drop of a dime, but I'll send you reminders and newsletters and free alpha moving forward. So that's kind of the point of that. All right, let's get into it. Does anybody have any questions about anything, burning desire questions that you want to go over real quick before we kind of get into the altcoin market today? And just feel free to talk, anybody at any time. That's totally fine.
Yes, I totally have a question.
Yes,
So my question is, with the market turning down the way it is, do you do any bit funded prop challenges? Like, our money is running in. I got 4 kids, man. It's like I got a 2-year-old, I have a 4-year-old, a 10-year-old, and a 3-week-old.
Wow.
So it's so hard for me to sit down in front of a computer and then do it. So I try to do a lot of this from my phone. That's one question I wanted to ask you. Do you recommend it? Don't do it from your phone, or what?
So are you talking about actually trading and investing from your phone?
Correct. I do everything from the phone 100%.
So I do everything off my phone too.
Awesome. Cool. I don't feel bad. My other question that I wanted to get into was the prop fund, like the bit funded things, because I don't have a huge amount to invest in and make big trades. And every time I use a little amount of money and make trades, I make profit, but a lot of it gets eaten up in the fees.
Yes.
I make money every time. My trades are in the positive, but a lot of times it's not very positive because there's such low amount of trades. So if I was to do something like bit funded on a downtrending market like it is right now, is it easy to get those challenges passed right away so you can get funded up for a big amount?
Yeah, I think again, if you have an execution strategy that is actually, if your expectancy is positive, right? So meaning if you're winning more trades than you're losing in terms of your risk to reward and actually remaining profitable in your P&L, there's no reason why you shouldn't continue, in my mind, actually using those execution styles at scale. But just be forewarned that, when you're using a prop fund platform, it's not your money, right? So things can get hairy real quick. Personally, I don't trade on credit. I really don't. I think for someone like you, when it comes down to fees, scale your trades, maybe take less trades, but it seems like your strategy actually works. So, and also when it comes to taking profits and scaling out of a trade, letting your runners run different take profit levels, there's going to be a point in time where as long as you're mapping out your trades and you actually have your exit strategy, you're not changing your exit strategy mid-trade, I think you can scale. I think you're at the point where, you know, are you trading like 20, 30, 40 bucks at a time? Is that the situation?
Yes, exactly. That's exactly right. Yep,
Yeah,
20,
I
30
think
bucks for each trade.
scale it up. Scale it up to 100.
Okay, sweet.
Yeah.
I'll try that for sure.
Yeah.
Yeah, man. Some of my P&Ls this week were like 200%. I'm like, golly, if I had done that with $1,000 instead of $20, it'd be a bigger number, you know.
Totally, totally. But, you know, and also the thing to remember is working with bigger numbers. Typically people, you know, it can be a more of a emotional game, you know? So again, as long as if you're scaling up, you're using bigger numbers, keep the same strategy. Do not change your strategy.
Okay, perfect.
Tighter stop
Sweet, man.
losses, tighter stop losses. Make sure your execution style is pinpoint. Make sure you're taking risk to reward, you know, 3-to-1, 2-to-1 at least. Like don't be forcing trades. You know what I mean? Just stay with
Right.
whatever execution style is working for you now. Scale it up a little bit. If it doesn't work, pull back. You know what I mean?
Totally.
Cool.
Great advice.
Yeah,
Thanks, sir.
absolutely. Anybody else have any questions? That's a great question, by the way. Anybody else have any questions before we kind of get going?
Hey, Dave, I got a quick question for you.
What's up, Tingo?
Hey, sir. How about is Femix, I guess, a good substitute for Blowfin? Because I already have a Femix account. They're pretty similar.
Yeah, I mean, look, as long as you're using a platform that has deep liquidity and has trading pairs that you need, there's really no issue. Femix has been around a very long time. Right. They're a good platform. I don't think they're any worse or better than Blowfin. You know, use what you feel comfortable with. That's the other thing too. You know, a lot of UIs like takes time to get used to them. If you know how to execute and where everything is on a certain platform, stick to it. There's no need to kind of spread that out. So yeah, I mean, that's kind of like a personal thing. But again, like as long as you're using a reputable platform that has deep liquidity, you're good. The whole point of using a platform with deep liquidity is you don't want to be paying any slippage. All right. So if you're not getting charged huge amounts of slippage fees, you're good. You're good.
Okay,
yeah. Good question. These are great questions. Technical questions. Any other questions like that before we kind of move in?
Are you having a boy or a girl?
Third boy. Wow. Bless you, Paul. Man's got his hands full over there. All right, cool. Yes. So we'll move forward now, and then again, there's going to be plenty of opportunities to ask questions and kind of get in the weeds of whatever topics that we don't cover you want to cover today. So we'll get there. All right. So first things first, guys, section 1, I think that we need to talk about risk and how risk is done correctly. So timing risk is better than finding setups. The environment that you're trading determines your outcomes. Execution only works in the right conditions. Most traders think they need better entries, but that's not actually the problem. The real issue is when they choose to take risk. You can have a perfect setup and still lose money if the environment is wrong. Today is about understanding when the market is paying you to take on risk. So an example of that is you take the same setup. One works during a clean trend. So in a trending market structure of either bullish or bearish, higher highs, higher lows, and one fails during Bitcoin volatility or sideways chop. Same setup, different outcome. We're not near a liquidity zone. We haven't had a certain break of structure yet. The change of character has not been confirmed. These sorts of situations. Trading is a game of probabilities, not predictions. It's a game of probabilities and statistics. Outcomes are distributions. We manage the risks, but not the results. Trading is not about being right. This is something that I've learned over time, is doing these, is having a YouTube channel about calling the future movements of the market. It's not about being right about the movement of the market. It's about which way and how we manage risk depending on which way the market actually moves. It's about managing those probabilities over time. Every trade you take is just one outcome inside a larger distribution. You're not trying to predict what happens next. You're trying to position yourself so that your edge plays out across many trades. That's why consistency comes from risk management, not accuracy. For an example, if your system wins 60% of the time, you still lose 40% of the time. Losses are expected, not failure. The edge plays out over a series and not one trade. And last week we talked about risk management and expectancy, and actually showing in practice the math works out in a way that you can still win 60% of the time. You're winning more trades than you lose. But you can still be unprofitable if your risk is not calculated correctly, if your expectancy is not calculated correctly. The core truth, guys, the same setup doesn't always equal the same result. The environment that we are trading changes the probability. So the context of the market structure matters more than the patterns we are trading. The same exact setup can produce completely different outcomes depending on the environment. And again, the environment is the market structure at any given time. This is where most traders get confused because they think the setup stopped working. In reality, guys, the condition changed, and that's what determines probability. If you don't account for environment, everything feels random. An example of that, 2 identical trades. One in a Bitcoin range wins. One during a Bitcoin breakout fails. The difference is context, not the execution. A lot of times when I think about this sort of situation, I think about trying to long in a downtrending market, trying to long every breakout, potential breakout, or liquidity sweep in a downtrending market. Statistically, we're not supposed to be longing in a downtrending market, and we shouldn't be shorting in an uptrending market. Definitely not at resistance or support, depending on the context of which way the market structure is moving at any given time. This is a very, very common mistake that a lot of people make. We need to wait for market structure to shift on the high time frame and the low time frame and be trading with the bias on any given time frame, market structure at any given time. That instantly will uptick the amount of times your expectancy actually increases. So the probabilities of you winning a trade, as long as you're trading with the trends, will give you a immediate boost in how well you're actually trading and what your expectancy is over time. The glue concept here is everything is risk allocation. And the environment, so the market structure, drives the outcomes, not randomness. I'm letting people in here as we go on, so bear with me. Okay. Not randomness, just the conditions. Every concept you're learning connects back to this one idea. Risk allocation across the environments, entries, exits, altcoins, Bitcoin. All of it depends on whether the market is rewarding or punishing risk. Guys, is the market right now rewarding or punishing risk? Simple question. Anybody answer? Is the market rewarding or punishing risk right now?
It's been punishing risk.
Punishing risk, for sure, right? And the market isn't random. It just behaves differently depending on the conditions. Once you understand this, your decision-making becomes much simpler. Instead of asking, is this a good trade? You ask, is this a good environment for risk? When risk is rewarded, clear structure, liquidity taken to the downside or to the upside. Liquidity must be taken. Displacement present. So what's the actual velocity of these moves? Are the moves violent, or are they small consolidation range moves with no clear market structure present? Is Bitcoin stable? Is it consolidating? Risk is rewarded when the market is aligned and clear. You have structure giving direction, liquidity already taken, and displacement showing real participation. At the same time, Bitcoin is stable and not disrupting the move. When these factors line up, your probability shifts in your favor, and that's when you should be aggressive. So an example of that, price sweeps lows or highs. Change of structure forms, change of character forms, strong displacement either up or down. Bitcoin stable, this is a high probability environment. So what we've been looking at over the last 3 to 6 months, as Bitcoin tops, ranges, chops, has a large displacement move, in this case to the downside. These displacement moves that we're looking for, these huge moves after 2 to 3 months of consolidation in a downtrending market, these are the moves that we're actually trying to capitalize on. We don't want to capitalize on any mid-range moves. We don't want to capitalize on any consolidation moves. We want to catch these moves of displacement, in this case, down from a change of character and a break of structure. And this is stuff that we go over in great detail in the courses. I know a lot of you guys are in the advanced trading course and you're probably thinking, yeah, that's exactly right. So again, what that looks like in practice, and what I want you guys to do too, is right now, if you're using TradingView at any given time, I want you to download the indicator or put the indicator on your TradingView. It's called Smart Money Concepts by LuxAlgo. This will show you the change of character. It will show you the break of structure. It'll show you the equilibrium. It'll show you the displacement. So you don't need to guess if you're not sure exactly what that looks like in practice. When risk is punished, chop markets, right? The last month and a half of the range we've been in, that is punishing risk, especially if you're going to be trading in any sort of altcoins right now. The mid-range, no displacement, Bitcoin volatility. Okay, the narrative is simple. Risk is punished when the market lacks clarity. Let me say it again. Risk is punished when the market lacks clarity. You'll see choppy movement, no real direction, and weak price action without any sort of displacement. On top of that, Bitcoin becomes volatile. Let me let another person in here. Welcome, Sam. Welcome, welcome. On top of that, Bitcoin becomes volatile and overrides everything else. In these conditions, even good setups fail because the environment itself is unstable. It's less predictable. For an example, price is stuck in the mid-range, which is really where we've been for the last month and a half. Weak candles in both directions. We've seen plenty of that. Bitcoin spiking, you take a trade, no follow through. How many people, guys, and be honest with yourself. You don't need to say it on the, you don't need to tell me now, but just be honest with yourself. How many of you guys were longing that potential sweep of liquidity highs at 74 a couple days ago or last week? If you're longing that breakout, guys, this is exactly what I'm talking about, okay? We do not long any sort of no displacement present liquidity sweeps against the market structure, right? That would have been a great short situation for sure. It would have been a great long situation if we gained acceptance above the resistance and turned it into support. But we didn't get either. We got a liquidity sweep, and we're headed basically back down to we're currently in mid-range, and we're heading back down to range lows. We'll likely revisit range lows to grab the liquidity there. Let me ask you guys a question. If we head back down to range lows around 61, is that a good long environment, good short environment, or do nothing environment? Anybody?
Long. That's a long.
Why?
Because from there we have to climb up.
No.
We would have to.
Well, so let's change the way we think about this. We don't have to do anything. Okay? We don't have, the market doesn't have to do anything. But I think that if you were to long the 61K back down to sweep that liquidity, I think that would be a decent opportunity. But again, let's think about why it's a decent opportunity. It's not because the market has to bounce there. It's just because the probabilities are stacked somewhat in your favor that you will get a bounce after you sweep liquidity. Now, if I were actually trying to take the most, the best trade I possibly could, you know what? Let's actually pull up the chart here and look at it so we can look at this together. I think this is a really, really good example of what I'm talking about. So we have our range, and let me actually draw these lines so a little bit more clear for you guys. Yeah, you go ahead. You don't need to raise your hand. Just go ahead and ask a question, brother.
So, David, a quick one, because I'm looking on the moving average 50-200, and I can see that there is a death cross that's been happening over there on the 4 hours time frame. If you can just have a quick look on it as well.
Yeah, so you're talking about a death cross of the 20 MA and 200, or the 50 and the 200?
50 and 200, sorry.
On the 4 hour?
Yeah.
Okay. So what about that?
Is it gonna create a downtrend because of that?
So when we're looking at, this is a great question. So when we're looking at death crosses on a smaller time frame, typically the death cross is actually an indication that the move has already happened. Something interesting about death crosses and golden crosses is because moving averages are lagging indicators, typically that actually means the move has already taken place, or the move is about to take place, coming to the end of that trend. So it really depends. It really depends. I'm not a big fan of moving averages when it comes to death crosses. I'm more of a fan of moving averages when it comes to support and resistance, or the directional trend of the market. For example, if a moving average is curling up, and all the other moving averages that are within that certain time frame that you're using. So let's just keep it simple. We're using the 20 MA, the 50 MA, the 100 MA, and the 200 MA. Okay, just keep it simple. These will be the simple moving averages. On any given time frame, if they're all moving and curling either up or down in the same direction, that's actually confirming momentum. If there's some moving averages that are diverging, facing different directions, that's usually an indication of a choppy market and the market's not making a decision. Very often, I think we've probably seen this in practice by now, the daily time frame and the weekly time frame will use these MAs as support and resistance. And that's true for the 4 hour, it's true for the 1 hour, but it also depends that if you're talking about confidence and confluence between the hourly time frames or the time frames that you're looking at, the larger the time frames, the more confidence we can have. So when it comes down to what does a death cross mean on the 4 hour? Not much. Not much. What matters more is the market structure on the 4 hour.
Thank you, Dave. Thank you very much.
Absolutely. And I'm not saying don't use it as an indicator, but what I am saying is go back and maybe look at how many times that death cross actually played out and what was the reaction of it. Was it a bottom? Was it the beginning of another leg down, right? So go back and back test it and look throughout history, maybe a couple of years, and just see it. All right, how many times did this 4 hour death cross actually cause a move to the downside? How many times did it call a bottom? And how many times did it actually create a move to the upside? And then just, statistically mark it out and say, okay, on average, this is what happens. So let's just use the statistics in our advantage. It might not happen again the same way, but at least this is what it has done most of the time when they've actually occurred. And that's how I use moving averages in general. I'm always going back and just looking at death crosses, certain indicators on a moving average basis. I'm always going back and kind of looking, okay, what happened in practice, right? And then take that in context in terms of what's the market actually telling us? Are we near a liquidity zone? Are we near high time frame support? Are we in an equilibrium zone? The whole bunch. What's the RSI? What is momentum looking like on a larger time frame versus a smaller time frame? There's a whole bunch of nuances, but we always need to look at the market in terms of a big picture, you know? Always look at the big picture. We're never going to use one indicator to dictate what our position should be. As much confluence as you can find between your indicators, the more confident you should be. So going back to, that's a great question, by the way. Going back to understanding liquidity sweeps and why we might be taking a long down around 61 if we take that liquidity, or maybe why we actually would be taking a short and what those circumstances would actually look like. So we grabbed our liquidity sweep. I'm sure a lot of people got excited. Okay, and we're breaking out. We didn't close. We didn't gain acceptance. And then we had a large displacement move back down into mid-range. Typically, once we take liquidity from either a higher range or a lower range, we actually move that market. And I can move that up here to show what that looks like in practice. We had our bottom. We had a nice displacement wick with a nice long candle. Beautiful move. High volume came in that day. Somewhat came back up to range highs, continued to build up liquidity back down to range lows. Swept these lows with a nice wick, came back up top, grabbed the liquidity, had a nice displacement rejection, somewhat back down to lows to another level of support. Okay, we can move these levels of support depending on what situation we're looking at. Had a nice displacement move, 7 to 8 days of green candles building up the liquidity to the upside, sweeping range highs to grab all this liquidity with a huge displacement move back down to the downside. Somewhat of a consolidation move, nice little bounce back at mid-range. Okay, that's why we got that bounce, mid-range support. Broke through because we couldn't reclaim that resistance to turn it into support. And now we're likely headed back down to range lows to grab and test this liquidity zone. Now, the whole point of this is really simple. As Bitcoin ranges in a certain range, it's simply building up liquidity. This is just building up liquidity. That's what a range does. It builds up liquidity. It traps limit orders. It gets people, either bulls or bears, excited. Right? It's ranging, grabbing and building liquidity. Now, what we can assume here, guys, is since we had a failed sweep with no acceptance to maintain a up move in market structure, we're going to go back and grab range lows. Now, either we could long this zone. We could. If we do, we should have a tight stop loss. What I would rather do in this sort of situation is I'm not trading ranges that much, not until we actually have a decision being made. So what does that mean in practice? A decision being made is breaking the range in one direction and gaining acceptance as we break that range. Because remember, guys, we just spoke about, we want to grab the big moves. We don't really care about these moves here. Look, you could trade them. You're scalping. These are quick. These are in and out trades. And the R&R isn't that great. So we kind of just don't take those trades. Okay? You could, like I said, but I don't think that's a great strategy because the more trades you take, the more likely you are to kind of fail over time. We want the great probability setups. So could we take this trade? Sure. We've had a few reactions down there that have been positive. I think it's a decent trade to take. Have a tight stop loss. What I'm looking for, though, is I'm looking for the break of the range, the retest of that support to flip into resistance, gain the acceptance, and actually trade that next displacement move to a new range. That is the high probability setup that you want to be taking. Does anybody have any questions on why I would actually be taking this short on a break of range to grab the liquidity, short the retest, and then short the acceptance of the retest on displacement rather than actually longing this move? And again, the reason I'm not longing that bottom, that support range, is because the market structure is down. Macro structure is down. I'm not trading against the market here. You can, but the probability setup is low. It is way more likely that we will break this range, Not saying it's going to happen, but statistics and probabilities say it's way more likely that we're going to break this range and have continuation to the downside, simply because of macro structures and is downsloping, right? Lower highs, lower lows, lower highs, lower lows. Until that changes, I'm not trading against the market.
Is it because? Sorry,
is
it because we are under the 200 MA?
Well, I mean, you can use that as an example. It's part of the reason, but let's zoom out a little bit and look at this in terms of what I actually mean. We are in a downtrending market. There is a rule of thumb that we follow if market structure is making higher highs or higher lows, or lower highs and lower lows. And remember this, guys. The trend is your friend. The trend is your friend. And that can be a diagonal trend that's cycle to cycle. It can be a market structure trend in terms of direction the market is moving. We don't want to fight the trends. We don't fight the trends because we have higher probability setups if we don't fight the trends. So the reason I would actually take a short at any given time, especially at a range high move within a range, right? Wouldn't long here, even though we had the liquidity sweep. This is very similar to what we just had here. The reason I'm not longing this breakout isn't because it doesn't have an opportunity to actually break the range of the upside. It's because it's more likely not to, because we are in a downtrending market.
Hey, Dave, I got a question.
Same would be true if we were in an uptrending market. If we're in an uptrending market, I'm not fighting the trends. Eventually, in an uptrending market, these ranges, because we're making a series of higher highs and higher lows on the macro, break to the upside. So it doesn't pay any dividend to fight the trend.
So technically, you're taking the 200 MA or any MA as a confluence and a confirmations of the trend.
Yeah, we can use MAs as a precursor to help us understand which way the direction of the market is going. But I'm actually saying it's simpler than that. You don't actually even need the MAs to know which way the market is moving, right? You don't need that because we're making a series of higher highs and higher lows.
Right. I see.
Low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, high, lower high, lower low, or excuse me, higher low, lower high, lower low. We don't even need MAs for that. They're useful, but like just look at the market structure. So when this actually changes, then we can go back to a long bias. Until market structure changes, your bias should be short. Period. Full stop. Full stop. Right? And that's just because you don't want to fight the trends. Now, let's talk about MAs. Let's talk about that in practice. I like EMAs and SMAs personally. It is true. It is true. And let's actually go to more price action history here. It is true, guys, that MAs, especially on the weekly time frame, really are lines in the sand historically in terms of where we can find a directional shift in the market, especially if you're using the 200, right? I keep hearing people, we've mentioned the 200 a few times here. If you're looking for market structure shift, we know the direction in the market structure now is bearish, macro structure. Here's a rule of thumb too, before I dive into this. You should be taking trades that align with the macro and micro structure. If the micro structure is fighting the macro structure always prevails. Always. If the microstructure and the macrostructure are aligned, that's a high confidence setup. So what I like to use in terms of moving averages, lines in the sand, are going to be the 200 on the weekly. Because again, I don't need it really for small time frames. Because I know if we have a series of higher highs and higher lows, or lower highs and lower lows, that is the market structure, period, full stop. That doesn't change until it changes. And if I'm not fighting the bias of the market, my probabilities of a successful trade go up astronomically. Astronomically. So what I do is I'm looking for potential market structure shifts on the macro instead of the micro. Then I can start to change my bias if the micro starts to align. So knowing this, right, how many times has the market found support near or close to the 200 EMA or 200 MA on the weekly time frame? Many. Most of the time. Most of the time. There was a situation last cycle where it failed. That's okay. Still 75% of the time, it found support. And it started the market structure shift. So what I like to use these for is not necessarily a trading situation for my low time frame setups, more about my accumulation of my spot bags for cycle to cycle or year to year cyclical accumulation zones. Now, there's other ways we can look at this instead of using moving averages. And this is what I mean by confluence. We don't want to use just one indicator at any given time. That's bad setup. That's a bad way to go about this. What we want to do is find confluence in the charts across multiple indicators that are trustworthy. So, for example, I could throw in here the RSI. Everybody loves the RSI. The RSI is a leading indicator. It's one of the few leading indicators out there. Moving averages are lagging indicators because they're averages over time. RSIs are leading indicators. Okay. I like to use leading indicators with lagging indicators on top of market structure. Kind of gives you that full picture. So a good example of this would be, we also can see from high time frame support and high time frame market structure that the market has actually found support at least the last two cycles, at least last cycle. And this is the log scale, so it would look a little differently if it was on regular, but it really did find support the last two cycles and this cycle as well, at least for now, of some sort of bottom from the previous all-time high or low within a cyclical move. This also coincides with the moving average that we were just talking about, the 200s on the weekly. It also coincides with the RSI on the weekly being oversold around or below 30 at the same time. We're not trying to predict the bottom being in, but we're saying from this, just these simple indicators of market structure alone, we can probably conclude that the bottom is in or close. So what that would mean in terms of structure is structure might be shifting. There are early indicators, given historical context, that this is around the time, around the price zones, around the liquidity zones where structure actually might start to shift. Or we come into some sort of accumulation zone out of distribution. We don't really want to be trading this environment because we don't know what's going to happen. This is typically when the structure shifts, so it's not a great time to trade it, but it is a great time to load up on cyclical spot positions. So there's your other different sort of environment situation. A great trading environment, guys, is when we're in a trend that actually is proven to be true, that doesn't look like it needs to break at any given time soon. But since we're at high time frame support, the RSI is oversold, historically where it needs to be to form some sort of accumulation zone, along with the moving averages acting as support. And actually could throw in probably one more indicator here. Let's throw in a diagonal trend just for shits. I mean, we're right in that zone of when the market should be bottoming. Does it have to bottom here? No, it doesn't. But again, we're not playing if this, then. We're not playing what we think is going to happen. We're playing what is likely going to happen. And again, trends are your friends. So we're going to assume these trends hold until they break. That's how we move. If the trends break and we have a new market structure shift, so let's just say the market does something like this. Breaks down, back tests the trend that we've held since 2018 and makes a move. We just change our bias and our positioning. That's it. That is all we do. Until these trends actually break, we don't try to presume it will. And that's true for the microstructure. That's true for the 4 hour. That's true for the 1 hour. It's true for any time frame you're looking at. That doesn't change. That's just the rule of markets. So
what makes us want to target the 55,000 though?
So why you're hearing, that's a great question. Why you're hearing 55, 51,000 being a target. It is very much a target. It is very much in play. It's because it's a liquidity pocket. Now, what does that mean? Right? How do we know what a liquidity pocket actually is? Why is one level like 51, the low 50s, mid 50s, more important than any other level right now on the chart? Okay. And that comes down strictly to order blocks. Order blocks. Now, there is an indicator for this. There's an indicator for everything. So if we can't kind of justify in our heads and say, okay, which I'll tell you what it is, right? An order block is going to be coming from a swing low or swing high displacement move. That causes liquidity zones and order blocks. Okay. Swing low, swing high, displacement move. Swing low, displacement move. Okay. This is what an order block, this is what forms a liquidity zone order block. It's where buyers and sellers are stepping in the most. Okay. This is why this zone is important. Now we can throw the indicator I was telling you about. If you can mute your mic just for a minute, that'd be great. It's called Order Block Detector from LuxAlgo. Click it. It's going to show you the major order block zones that are important. These are where reversals or continuations take place the most, depending on the time frame you're looking at. So if I'm looking at the weekly, that's a stronger order block zone than the daily. If I'm looking at the daily, that's a stronger order block zone than the 4 hour, and so on and so forth. Right? The weekly really matters in the situation. So, why is it such an important zone? Because look at the order block. It's a huge order block from 8 months of consolidation participation around last cycle's all-time high. This was really the move that brought us into our bull market. This was our breakout of previous all-time high. This is where the most amount of participation was. And this is where the most amount of sitting liquidity still rests. So it is likely, statistically, that we will at least take this out. We don't have to. The market doesn't owe us anything, but it is likely. And if we do, it's probably going to be a very, very quick move. You're probably not going to see something like this. And that's because liquidity has been taken, the fuel is lit, and we move. You'll probably see something like this. Black swan, boots on the ground, Market's freaking out. Stock market completely rolled over. Great time to get everybody all upset in the market. Take this zone, have a nice bounce out of the zone because that's the largest OB. Come back, consolidate around this zone, get rejected, come into accumulation, then move out of the zone. Very, very unlikely we'll be sitting in the zone for a long period of time. Very unlikely. Very unlikely. If we reach this zone, guys, if we reach 51 to 48, the bottom is probably in. Based on market structure, based on the RSI, based on a lot of other indicators. So that's a great question. I'm glad you asked that because that is an extremely important zone.
Can you show us how to do order blocks? Hey, Dave, by the way, can you show us how to do order blocks without the indicator? Because that's something I never was able to figure out.
Yeah. It's just, there's a simple rule here. Swing high, swing low. Swing high, swing low, displacement. That's it. Swing high, swing low, displacement. If you have wicks, it's a stronger swing low or swing high.
Okay, I still don't get it, but
okay, here, let me show you. Let me show you. I'll show you. That's okay. So let's go to the 4 hours. Probably a little easier to see. So we have our order block set up right now. Okay, this is the indicator that tells us what it is, where they located. Remember the rule I just told you. Repeat the rule back to me. Swing high, swing low, displacement. Say it.
Yep, I'm with you.
You with me?
Yep.
Swing low, displacement. Swing lows, displacement. Swing high, displacement. Swing high, displacement. That's it.
I see it. I see it now. So now I don't even need the indicator.
No, you don't need it. You don't need it. But they're useful. You know what I mean? Like if you're not
totally make it easier to visualize it.
Yeah.
Yeah. So what about fair value gaps?
What about them?
I don't know. That's another thing I can't figure out.
Okay. Well, let's talk about that. Do you know what a fair value gap is?
Not really.
Okay. Let's define a fair value gap real quick. A fair value gap is an imbalance in the market where buyers or sellers take over violently. So it's an imbalance in the market where either buyers or sellers take over completely, violently within a certain move. Okay.
Okay, I see. So like the big candles you're looking at pretty much.
Yeah, or
okay.
like a bunch of candles in a row that are negative that come that or bearish or bullish candles that come in over time where buyers really can't or sellers really can't step in to stop this move from happening. It's a good way to say it. So what we can do is we can actually look at that in terms of an indicator too. And this goes back to smart money concepts. Now, fair value gaps aren't that common, and they can fill really quick. Trying to see if I see any fair value gaps on the 4 hour right now. I don't see any. Let's see if we can go to the 1 hour and see any. Let's see here. Okay, I see one fair value gap here. Okay. Now, what fair value gaps again? Let's define it. Imbalances in price action. You can see the imbalance in price action. Quick, highly volatile move where buyers didn't step in at all. Okay, that's liquidity imbalance. What that means is usually price will find a way to fill that imbalance. Usually. Now this goes into entries and like this goes way into our advanced trading course. So we could talk about fair value gaps for 5 hours. Okay. We don't have time for that today. But again, the basic rule of thumb for what a fair value gap is and how we use them, it's an imbalance of liquidity. And you can see that imbalance through how strong this move is. Well, the market will eventually come back and refill the imbalance. Doesn't have to, but it usually does. Again, if we're using smaller time frames like the 1 hour, it's less likely to happen or fill quickly than it would be on the 4 hour or the daily. So the time frame you're using really does matter here. The larger the time frame, the more confident we can be in the potential moves. We want to always enter a trade after gaining acceptance around filling a potential price imbalance, a fair value gap. So let's say price did actually come back to fill that imbalance instead of chopping around down here. This would have been a perfect entry to probably take a short after we came back to fill the imbalance, considering structure is still bearish. Does that make sense?
Yeah, it does. Thanks, Dave. And
Hell
you
yeah.
know, another question I had was, is there such thing as an inverse Bart Simpson pattern? Because I know the Bart Simpson pattern, but is there like an inverse one?
Sure. Yeah.
Okay, that's what I figured.
Yeah, it's an accumulation range. So
Yeah.
so go ahead.
So what you were saying before, that we are most likely going down, because I mean that would be like bear flags anyway, what you were talking about before, because we're in a downtrend. But is it possible? Well, of course, anything's possible with this, but that maybe it could be like an inverse Bart Simpson pattern. But I would think probably more so a bear flag. But you know, because the trend is your friend, right?
Right. Exactly.
Yeah. Yeah,
exactly.
I get you.
Friend's your friend. Right. No, you said it. You said it perfectly yourself. So, and let's actually look at this in practice again, because I think this is really important. Interestingly enough, that in a bull market, we have high velocity moves. Let me get rid of this. We have either sideways consolidation. This is in a bull market, so higher highs, higher lows. That resolve to the upside. We have consolidation in some sort of flag that resolve to the upside. We have corrections that can move down or sideways that resolve to the upside. Okay. This is a bull market. So when we have our moves in a bull market, we actually consolidate down or sideways, really typically down more often than not, that resolve up. In a bear market, we have downward displacement consolidating upward.
So, sorry, Dave. Can I ask you something over here on that?
Yeah, for sure. Go ahead.
Isn't it at the structure of a bear flag? This one, when it goes down, then it goes a bit up with a three. It goes like 3 times up, then it bounces back down.
Say that one more time.
Does it look like the bear flag? This one, this structure, is it the structure of a bear flag when it goes down trend?
Yeah, this is a bear flag. This is a bullish flag or bullish wedge or whatever. So yeah. Bullish consolidation is always consolidating down. Bearish consolidation is always consolidating up. It almost seems counterintuitive, doesn't it? But it's not. So this is just how structure works. So another way you can think about it is in a bull market, price actually spends more time going down than it does going up. Crazy to think about it, but it's true. In a bear market, price actually spends more time going up than it does going down. But in a bull market, the moves are so big, right, and so violent and so fast that it makes up for the downward consolidation. In a bear market, the moves down are so big and so fast that it makes up for the upward price action. Isn't that crazy to think about? It's very, very interesting.
Hey,
So
Dave.
what we need to see is actually something like this. Then we can start to consider a breakout. Right? Then we can start to consider a breakout. This would actually what accumulation look like.
When you were talking about acceptance, is that like another way of saying like a specific candle closure, or is it like a trend formation, like the three white soldiers or whatever kind of situation? Yeah,
It's both.
Okay.
It's both. Yeah.
So how do you get a good eye on knowing when, I guess, a single candle closure is enough for acceptance, or
it's never enough.
Never enough? Okay.
You'd want at the very least 2 weekly candles.
Okay.
Yeah. You can tell sometimes before 2 weekly candle closes that it's enough, depending on the reaction of the candle and wick at the important level.
Okay, because I've always been kind of curious about how effective the wicks really are, because obviously the candle close is more definitive in telling what's going on, but the wicks kind of is more just the volatility. Is that correct?
Yeah, the wicks are the precursor to the next body candle.
Okay.
So like for example, let's go back to the weekly time frame from 2025, 2024. The one we were looking at the 8-month consolidation range. Let's go back to that and just see why there's acceptance there. Why it was likely acceptance. And there's a few reasons. One, it was the 618. So that's the golden pocket retracement. So that was a huge indication. Let me just delete some of these things here. Actually, we can keep them for now. That's fine. So there's a few reasons on why that was probably a high acceptance move right here, right? One of those reasons was because it was a liquidity grab back down to the previous wick zone. Mm-hmm. Okay, that was our first indicator. Okay, almost perfect, right? Another indication was we hit the 618. We all know the 618, the golden pocket ratio, is what we want to see in terms of a reversal in a continuation market. That was number 2. So we grabbed the liquidity. We hit the 618. We were already consolidating. Let me remove the 618 and remove the fibs. We also had that wick down below our previous resistance or previous support. That was our third indicator. I could throw another indicator on here and just say volume. Did volume come in? It did at that point. High volume on a capitulation. Nice wick off important levels.
That would be on the is that a doji candle? Is that what that is right there?
Yes, it's a sort of doji, correct.
Okay.
And so, I mean, that's a pretty good indication that likely the local low was in, and it was. We came back and revisited this level here. We held successfully gained acceptance, broke out finally from our zone, our resistance, our horizontal resistance zone, and look at the move that followed once we gained acceptance above that zone too. Big move, large volume. So over time, I think a good way to say this is over time, you'll recognize these things as likely situational, likely, a highly likely situational play. Not really, maybe I'm not phrasing that correctly. Of that in a certain trending market, depending on these technical levels being hit and accepted above with nice reactions around, you don't need you don't need to wait for that confirmation. You probably still should, right? I wouldn't necessarily open along here just because we got that nice wick at these levels. I probably still want to wait to see if we come back to revisit the level. But it's a good indication in terms of the trend is likely starting to shift, and it did. It did. That's where the trend started to shift. So it's an early warning sign.
I'm assuming these are more accurate on longer time frames and less likely on like hour, 2 hour, whatever.
100%.
Okay, thank you.
Yeah, great question. All right, let's get back into the slides.
Hey Dave, real quick, I just wanted to mention, not a question. I just wanted to mention that on YouTube, there were some people asking to get in. I wasn't sure like if you were able to pin the link. I shared the link over there, but
oh, thanks, bro.
I don't know if it's I don't know if it's clickable though. So I just wanted to mention that some people were looking. They were asking if you were taking questions from YouTube chat. I was like, no, you got to join the meeting, and I posted the link, but I don't know if it's clickable, so maybe you can put it as like a pin or something like that.
Maybe
Make it easier for them. Yeah.
Dude, thanks. I appreciate that.
And also, I wanted to apologize for asking the advanced questions. Like, I don't want to like throw everybody off and confuse people. So I know you have like a structure of how you're doing things. So I'll try to like keep my questions more like in line with what you're doing, because I don't want to go completely off topic and screw up your plan. Your
no,
lesson
you're
plan.
good, dude. No, you're good. This is the point. No, don't apologize. I appreciate what you're asking me. I like these questions. Keep asking them. Don't worry about the structure. Sometimes I have a plan and it just goes off course because what you guys are asking is more important. So no, you're good. You're good, man. I appreciate that, but you are good. Don't worry about it.
I appreciate you, Dave. You're awesome. Also, one last question. Now, this is completely random. Now, you're like a friggin' encyclopedia when it comes to this stuff. You know everything. Like every question we have, you have the perfect answer for. So now, with you having all this knowledge, do you think that trading is really a thing that can, like, I don't know how to say it. You probably know where I'm getting at. Do you think it's because all these people online are always bragging about how they're getting rich from this and that, and I just feel like they're bullshit and they're just trying to sell something. So
they are. Half of them are fakes. There's actually a couple of guys on YouTube that actually go after all these so-called trader people and all that stuff, and they expose them for being frauds. And the only way
I saw that.
And
like that moving average guy or something.
Yeah, they're not making money by trading. They're making money by selling courses. They don't know. Like there was one guy using an account trading live, and he was actually using a mock thing on I forget what exchange, but it was actually a fake account. It wasn't his. It was a mock account, and he got burned. And when you look at when these guys got popular, it's only when they started selling courses, but they don't know shit. So don't fall for that trap. I fell for that in the very beginning of my journey too. You have to find a guy that's reputable, and also when you do you take the same method with copy traders too. If you see a huge spike in someone's popularity or compared to someone with a huge spike in their profits, they're gamblers and they're fakes. Don't fall for that shit, man. I'm telling you, they're everywhere too. You got to find guys.
Put a heads up with that.
Those are the real ones.
I kind of agree. Look, I'm pretty straightforward with how I operate. Trading is fucking hard. Okay? Trading is hard. I am not the best trader. I'm profitable. I know how to trade. But it's hard, man. And it's probably the hardest thing. It's probably the hardest skill to learn in finance in general. Okay.
Can I just add one thing, guys? Sorry, I
Yeah.
actually picked up a copy of this. It's called Turtle Traders. If anybody heard about that book, it's a small book by some guy. It talks about the difficulty of learning how to trade, and he tries to get it down to the most simplest form. And it's something either you can comprehend or you don't.
Yep.
But it is learnable and it is profitable. This is a
Agreed.
guy that took like a $3,500 loan from family and turned into a couple of million on the stock exchange.
Yeah.
There are certain things. Dave covers actually all of them, to be honest with you.
Yeah.
When I started reading this book, Dave hits on all these things that are the fundamentals, because a lot of it is designed to confuse regular people.
For sure.
Like,
For sure.
You just have to be very strategic. Like, don't just jump on anybody's train, is all I'm saying, man. Because I lost money in the very beginning of my journey, getting fucked up with some people, and then I had to totally reset. And then from that, I'm on this journey now. I think I'm in year 3. I have made money. I have lost money. But to the original point, man, just watch who you choose to follow. There's not a lot of real guys out there, man.
Hey, that's
Anyone
why I
with-
follow Dave, and Dave pretty much is all I follow now, because I
100%. Dave's one.
yeah,
of
I've been down the
them.
road too, man. I know like all these people from Crypto Banter, all these people from, I'm not going to mention names, but all these
Yeah, I-
people from all these places, they just talk a bunch of nonsense sometimes. And it's like, I found somebody with his shorts pretty much. Those shorts
Yeah.
were amazing. And
That's
it's
what
like,
got
this
me
guy
too,
knows
bro.
his stuff. Yeah.
Yeah.
So,
That's
because I
what
know a
got me
little
too.
bit. Yeah, I know a little bit over the years. I picked up a lot of things. So I know that everything Dave was saying was like, wow,
Yeah.
talking about the Gaussian channels and all this stuff. It's like, this guy
Yeah.
knows everything.
The Bollinger Band and all that stuff too. Yeah, the Bollinger Band's a real good one too to use. I learned that one from Dave too. But everybody else, they're like a fucking Andrew Tate, man. They're all fucking fake pussies. I don't give a shit. If anyone
Yeah, I
gets
mean,
offended.
Look,
So-
I tend to agree. I'm not, I try not to judge too much, because,
Well, you should be judging on someone level because people.
but,
they're stealing money from people.
but it's true, guys. It is true that there's a lot of charlatans out there. I try to keep my X account in the videos the shorts that I make, and the videos that I use, and the charts that I use that aren't mine sometimes, to the people who I know are reputable. This is why I talk about Seth sometimes, why I talk about Skylodeck and Crypto Killa, and like there's these guys out there, Trader Main, and there's some people out there that they know what they're doing for sure. And there's other people out there that just rage bait, and
There's a good way to know it. If anyone's selling a course, stay away.
hey, wait a minute.
That's what I've really learned. If someone's like saying,
watch your mouth.
No, I'm not saying compared to, like, look at something like Andrew Tate, for example, what he offers. Okay. Look at somebody like an Andrew Tate. He offered this course. So people start investigating the course. And that's when one finds out. Now, Dave, I'll put your course to test. I took the first one.
Right.
No one can say anything. Like, people put Andrew Tate's real world thing on test, like in real time. It's fucking bogus.
Yeah. Oh, I know it. Right?
I
downloaded it for free. I downloaded it for free, like in a backlink, just because I just was interested. I wasn't paying for that crap. And you're right. It's junk. It's complete junk. The whole thing is just nonsense.
It didn't work for anybody. Like 24 guys tried it, like live. None of it worked. Yeah. It's all
It's like, you want to be rich doing drop shipping, you want to be rich doing trading, you want to be rich doing this and that. And it's like, everybody's already doing this.
Go buy fucking tight pants and fucking mortgage your life and buy a Bugatti and be a faggot like Andrew Tate. That's his
hey, don't get me banned on YouTube.
I'm just saying, fuck, if they want to, fuck them too.
On YouTube.
Wait. Let's just say something. I want to say something about this, because I think this is important. I think that as long as you enjoy what you're doing, and as long as you're willing to put in the time and effort into whatever it is that you're doing, you're going to do well. I think that there's some people out there that get things quicker than most. I've been doing this for 8 years, guys. I met people who've been doing this for 2 years, 4 years, and like it's like, it blows my mind. It's like, how did you get this so quick? I also have met people who've been doing this for 20 years, and I'm like, dude, I don't know why you're still doing this. It really just depends on, like, can you find, and this is what I've learned, It's not about how much you know. It's about how good your system is. That's it. And that's why I'm trying to give you guys the tools in a system that I do know works. Like Darko said, the things I'm saying, I didn't make them up. They're not my words necessarily, but it is the system that has been proven to work over time. And so as long as you have a system that is duplicatable and scalable and you enjoy it, you're going to be fine. You're going to be fine. And trading is difficult. Trading is hard. Investing is actually relatively easy.
Oh, investing's simple.
Trading is really hard, right? And so this is why we talk about risk management, because risk management, guys, is everything. To be honest with you, we don't even need indicators. They're helpful. They can paint a picture. But over time, you start looking at market structure and what market structure tends to do. That's why we talk about market structure so much.
Yeah, it's all about support and resistance.
It really is. It's all about liquidity, support, resistance. That is so true in a lot of ways. And then you build a risk framework around that, understanding why your stop losses are where they are, understanding why your take profit zones are where they are, understanding, why the market is moving the way it is. You're like, this is the key. This is the key. And to be honest with you too, the hardest part isn't actually understanding those things. It's executing on those things, not letting the mind of potential potential successes or failures that are in the future. We don't even know what's going to happen yet. Shift you out of your risk framework, right? There's a reason why a lot of people are not buying these zones, right? There's a lot of reasons why people aren't buying 61 to 74. You know what? Hey, you might be right, bro. You might be right that we go to 51. You might be right that we go to 40. You might be right we go to 32. That's not the point. That is not the point. The point is you buy risk to reward, and you have zones, and you know where your thesis is invalid or valid. That's the point. That is the point. And so let's just say we are bottoming out here and we don't go to 51. How many people are going to be buying back at 92 because they didn't get the 40? They're not convinced the bull market is back until we're close to 100K. All right, so they're buying back towards what? Or if, they don't think we're in a bull market, if people still think we're in a bull market, they're buying every dip and they're going to waste, they're going to be having a hard time for the next 6 months. The last 6 months have been really, really hard.
That's why I like your charts that you post where you put DCA out, DCA in, DCA or do nothing, or DCA out. I like those charts because it pretty much says like, hey, you know what? It's not going to make it too difficult if you want to do investing, but it is a way to be profitable at the end and take your profits and not actually, round trip or whatever you want to call it. So
buy support, sell resistance. If there's one rule that I think people want me to take away from here, buy support, sell resistance. Buy support, sell resistance. I think people get caught up in let me get the 10x. Let me get the 5x. It's not about who makes the most amount of money. It's about who keeps the most amount of money.
Right. Wow. Right. Yeah, because I round tripped a lot of my alts this time, and I was holding on to hope that, we're having an extended cycle, this and that, but, it was stupid because everything, I look at the others chart, right? And it was so clear as day. We broke the structure, we retested, and then we dumped. This happened before October 10th. October 10th was it wasn't Trump that was like the catalyst that caused it, but it was the market structure. It was ready to go.
It was ready to go. And we got rejected.
Yep, the rejection.
So now we change our bias. Right? Yep. That's it. We have to be flexible. Right, we have to be malleable. We have to be willing to change our opinions. For me, I'll be clear. Let me be clear about this. I'm sure you guys probably know this about me, but let me just be clear, okay? I was not convinced the bottom or the top was in until we broke the 50 MA and never reclaimed it on the weekly time frame, okay? In hindsight, following my own rules that I know, I know very, very well. Okay. I should have said as soon as we broke structure, the top was in.
Yeah, we were all holding on to hope. You know,
Right?
it just felt like 120 just wasn't there. Like it felt like 140, 145 just felt like it wasn't there, even though there were so many things in line that pretty much said this was the end of the road, but I just
Yeah.
didn't want to believe it.
Well,
I was in denial.
That's okay. That's okay. But
Yeah.
as soon as we broke structure, right, and as soon as we got rejected, I changed my bias. Right. The whole point is you have to be able to change your bias at some point. Right. All right, we're going to move forward on talking about alts. But no, these are great conversations. And I think this is everything we're talking about is just so important here. It's so important.
Yeah, I appreciate you, Dave. I'm going to put it on mute now, but I appreciate you.
Absolutely.
Thanks for the conversation.
Oh.
Also, if you want, I'm just concerned about the S&P and all that, but I know we're going to do alts first, but just if we could just quickly look at S&P after all this,
Sure.
I just want to, because I think that we may have broke down a little bit, but maybe we could talk about that if you want. But
Yeah, no, we can talk about that later real quick.
Right.
Yeah,
cool,
absolutely.
thanks.
All right, so let's move to the altcoins. So Bitcoin versus alts, and I'm going to kind of just run through this. Okay, this is going to be on YouTube, so you can review it a few times. But I want to run through this because this is kind of what I want to talk about today. So Bitcoin is the liquidity engine. All right, so whatever Bitcoin does, the rest of the market follows. Bitcoin is the proxy for the rest of the market. Right, alts follow Bitcoin. Flows move top down from the least risky to the most risky. Bitcoin is the main driver of liquidity in the market, and everything flows through it first.
Yes.
Capital typically moves from Bitcoin into ETH and then into altcoins. We didn't see that really happen this cycle. We saw glimpses of it, but we didn't get the full rotation. If Bitcoin is unstable, it disrupts everything downstream. That's why you cannot analyze altcoins in isolation, right? This is why we don't analyze altcoins in isolation, right? This is why we talk about Bitcoin so much. If Bitcoin dumps, alts dump harder. If Bitcoin is stable, alts start trending. Bitcoin sets the conditions, guys. When Bitcoin is trending, it has a strong direction. Liquidity stays in Bitcoin. Alts underperform Bitcoin in this scenario. Does not mean alts can't go up. They very often do in their USD pair. But they are not outperforming Bitcoin. When Bitcoin is trending aggressively, most of the capital stays concentrated there. Traders are focused on Bitcoin. So altcoins don't receive enough liquidity to sustain strong moves. This leads to fake breakouts and choppy behavior in altcoins. Forcing alt trades in this environment usually leads to losses. This is why we focus mainly on trading Bitcoin. Bitcoin breaks out strongly, alts break resistance, immediately fails because there's no liquidity rotation yet. This is why when people talk about Bitcoin dominance breaking down, it's like, no. We are not going to see an alt season until Bitcoin actually makes a new high or is trending in the right direction. We are not getting an alt season. So any Bitcoin dominance chart you see, altcoins around the corner, we need to see Bitcoin make a directional push to the upside first. Guarantee it. When Bitcoin is ranging, there's stability, right? This is why last cycle, if anyone was around for that, when we were ranging around 60 to 69 for a period of a few months, we had Bitcoins really outperform. Capital is rotating at that point. When Bitcoin is ranging, the market becomes more balanced and stable. This is why we're looking for consolidation in Bitcoin to the upside. This allows capital to rotate into altcoins, which is where most altcoin moves actually happen. Sure, there's always some outliers, but the majority of the market, the 75 out of the top 100, this is what we need. Structures are cleaner and follow through is stronger. This is the environment where you want to be the most active in trading altcoins. For example, Bitcoin is flat-footed for a few days in an uptrending market, right? That's critical. Market structure has to be bullish. Alts start trending. This is your opportunity window. When Bitcoin is volatile, liquidation cascades tend to happen. Unstable market structure. It's a risk-off environment for altcoins. When Bitcoin has high volatility, you trade Bitcoin. When Bitcoin's volatile, the entire market becomes unstable. Price moves quickly in both directions. Stops get triggered and structure breaks down. In this environment, it's very difficult to maintain any edge because conditions just change too quickly. This is where most traders lose money. Not because of bad setups, but because of bad timing. Example, Bitcoin spikes up, alts follow. Bitcoin reverses after that spike out, alts dump hard, right? There's no consistency, which means you have no edge, right? And we are only looking for the edge. Environment model. Trending market, trending Bitcoin, you are defensive. Ranging market, and again, has to be in an uptrending market. Right now is not the same condition, low liquidity, bearish market structure. So it has to be bullish market structure, high liquidity. Ranging market, then you can be aggressive. If it's volatile, you just sit out. You don't need to trade every condition. You just need to recognize the right one. Different environments require different behavior, and when your strategy should adjust accordingly. When Bitcoin is ranging, you become more aggressive. When Bitcoin is volatile, the best decision is just do nothing. Example, Bitcoin is trending. Focus on Bitcoin and reduce your alt positions or don't trade altcoins. Ranging Bitcoin in a bullish market, rotate into alts. Volatile Bitcoin, no trades. If Bitcoin is making 10 to 20% moves a few times the next few weeks, sit out. Key concept here, guys. Alts is just a leverage on Bitcoin. They are amplified moves, and they also are amplified risk. Altcoins are essentially leverage on Bitcoin, meaning they amplify whatever Bitcoin is doing. When Bitcoin is stable, alts can outperform and trend cleanly. But when Bitcoin is unstable, alts exaggerate the downside and become very difficult to trade. Understanding this relationship is critical for timing entries correctly. So, for example, Bitcoin up 2%, alts go up 8%. Bitcoin down 2%, alts down 10%, right? Amplification works both ways here.
Yes, I got to say a couple of my trades this week were just like that. Like I watched Bitcoin when this was going down and it first started. I jumped on a trade for Pengu. I'm going down and it like 10x compared to, just what you would have got from Bitcoin 10.
Right.
But yeah.
Right. Exactly. So we can see this in practice. Section 3, entry, timing, core execution. Entries are not from patterns. Okay, this is really critical. You need context of your entry, of market structure, plus the location, plus the confirmation. Execution is just a reaction. Most traders focus on patterns, but patterns alone do not create the edge. Entries come from combining context. Remember that word, confluence. Location and confirmation in one process. You are not predicting where price will go. You are reacting to what the market is already showing you. Without all three pieces, entries just become random. So patterns alone typically fail. Pattern plus context plus confirmation, that works. Structure matters more than signals. All right, here it is again. Market structure matters more than signals, matters more than indicators. Context. Bitcoin condition. What's it doing? What's the high time frame trend telling you? What's the market regime? Are we in a low liquidity environment, a high liquidity environment? Context is the first filter and the most important one. Before you even consider an entry, you need to understand what the broader market structure is doing. This includes Bitcoin behavior, higher time frame structure, and overall market conditions. If context is wrong, the trade is wrong, no matter how good it looks. So an example, clean altcoin setup, but Bitcoin is volatile. Trade fails despite the setup. Despite the setup. Step 2, location. Liquidity. Goes back to order blocks and fair value gaps. Range highs, range lows. Location determines where you should even be interested in trading, right? And everybody in the advanced course knows we're not trading mid-range. We don't do that around here. As a low probability setup. Price only matters when it reaches areas where orders are concentrated. These include liquidity zones high time frame levels, and key structural points. If price is not in a meaningful location, you don't have an edge. So an example of this I like to talk about is if you have a bearish or bullish engulfing candle in a mid-range, that's not as important as having a bearish or bullish engulfing candle at high time frame support or resistance. It doesn't matter. People will trade these bearish or bullish engulfing candles thinking that it's a reversal when it's not, because we're at mid-range. We need to be at resistance or support, liquidity zones. No more entering trades mid-range. That's what I want you guys to walk away with today. You're not trading mid-range ever. Don't do it. Entry at high time frame confluence levels with low time frame confluence levels, that's the reaction. That's the location that creates opportunity. That's where your high probability setups actually occur. Step 3, the break of structure and the change of character, right? We have to have break of structure, change of character, and the displacement move plus candle confirmation. This is critical here.
Hey.
The trigger is what confirms your idea. It tells you that something has actually changed in the market, not that price has reached a level. You're looking for structure shifts, strong movement, and confidence through price. Mute your mic, brother. Without a trigger, you are guessing. Price at a level, no reaction, no trade. Price at a level plus displacement is a good entry confirmation. It validates the area. Break of structure, what does that mean? It's a continuation pattern. Change of character is an early indicator that there's a potential shift about to occur. They are different signals. Break of structure and change of character serve different purposes in your analysis. Change of character signals that something may be changing, but it's not confirmation on its own. Break of structure, on the other hand, so breaking a support or resistance zone, confirms continuation in the direction of the move. Understanding the difference prevents you from entering too early, right? We want confirmation, guys. We want confirmation. Change of character appears first. It's an early signal. Break of structure follows the confirmation. That sequence matters. And again, this will be showing up for you if you're not sure what this actually looks like on the Smart Money Concepts indicator. I want that indicator to be your new best friend. Displacement. This is the high velocity moves that we're talking about. Strong moves are intent. Weak moves are a trap. Displacement is the most important concept in execution. It shows that real participation is entering the market with conviction. Strong, aggressive movement indicates intent, while slow or weak movement suggests uncertainty, right? We want high probability setups. We want aggressive movement. Without it, the move is more likely to fail. Let someone else in here. Oh, Clyde, welcome, brother. Okay. Large impulsive candles, they're the real moves. Slow grind around a support or resistance level, those are fake. The speed of the move reveals the intent of the market. Liquidity sweeps are meant for one thing, guys: to trigger stops, to trap traders, and to create fuel for the next move. Liquidity sweeps are what create the conditions for the real moves. When price takes out stops, it traps traders in the wrong side and provides the liquidity needed for continuation. This is why moves often begin after the sweep, not before it. And we saw that again this week at 74K. Understanding this shift shows how you view entries. Breakouts fail, we sweep, reversal begins. That trap creates opportunity. Full entry model. Liquidity, we sweep, we get a change of character. We get the displacement move, the break of structure, the pullback, then we enter. This is the full execution model and how all the pieces come together. Each step serves a purpose, and skipping one reduces probability. You are waiting for a sequence, not a single signal. This creates consistency and removes randomness from your entries, right? So if we're missing displacement, it's a weak trade. If we get the full sequence of liquidity sweep, change of character, displacement, break of structure, pullback, entry, that's the sequence we're looking for. That process creates edge over time. Your key edge here, guys, is sweep plus a stable Bitcoin. That's the best scenario. Worst, Bitcoin is an expansion one way or another. The environment of Bitcoin overrides everything in the altcoin market. Even with the perfect setup, the environment can override your trade. The best entries happen when liquidity is taken and Bitcoin is stable. The worst entries happen when Bitcoin is aggressively moving and disrupting structure. Always prioritize environment of Bitcoin over any altcoin setup. The perfect setup plus Bitcoin volatile is fail. A good setup plus Bitcoin stable works in context, which creates a great execution model. The truth here, guys, is this. Retail buys breakouts. That's the truth. They FOMO. They buy breakouts. Professionals buy after the traps. The timing is the difference. The difference between retail and pros come down to timing. Retail traders chase breakouts while pros wait for liquidity to be taken first. This is why liquidity is everything. This shift in timing is what creates your edge. You're not chasing moves. You are entering after the trap is set. Buying and selling. When to buy? After the sweep, guys. After the sweep. After the confirmation, so gaining acceptance, and at key important structural levels. Buying should always come after confirmation, not before. You're entering once the market has shown its hand, not when you think it might move. This reduces uncertainty and improves consistency. Waiting for confirmation is what separates disciplined traders from emotional ones. Example, early entry, drawdown. Confirmed entry, immediate move. Patience improves timing. What you're buying fear, guys. You're buying pullbacks, and you're buying reaccumulation. You're not buying distribution. You're not buying greed, and you're not buying large, green candles. Those days are done. You're not doing that anymore. When you buy correctly, it often feels uncomfortable. You're buying into fear, not into strength. This is because the best opportunities come after traders are trapped or shaken out. Comfort usually means you are late. You're not buying the mid-range, you're not buying the breakout, and you're not buying the emotional moves. That ends today. Most losing trades come from poor positioning, guys, not bad analysis. Buying mid-range gives you no edge. Chasing breakouts often lead to getting trapped. Emotional entries ignore structure entirely. Avoid these mistakes and improve your results immediately. Example is, breakout entry, we get a reversal. We saw that at 74 again. Structured entry, acceptance at either resistance or support equals continuation. Avoid obvious trades. When to sell? Into liquidity, into strength, into expansion. Selling should be as structured as buying. You're not exiting randomly. You're targeting areas where prices like to react. Liquidity, swing highs, swing lows. These include liquidity pools and extended moves. Selling into strength ensures you capture profits before reversal. This is why I say take profits. This is why taking profits is the hardest part. You hold too long, you give back everything. We all know what round tripping feels like. Sell into the target, lock in your gains, and exit. Then we wait for the structural pullbacks and we compound our gains. Exit rule. Edge gone equals exit. Stop limits. If the market moves against you, you exit, right? A little loss is better than a big loss. Your exit should not be emotional. I'm sure a lot of people right now are asking themselves, should I exit this market now? The answer to that question is absolutely not. You should be buying at these zones. Not random. You're never just randomly selling. You should have a positioned play and a strategy, and you execute on that strategy every single time. The decision to exit should always be based on logic, not emotion. When your original reason for the trade is no longer valid, you simply exit. This keeps your process consistent and removes the guesswork. Emotional exit leads to inconsistency. And the whole point of being a profitable trader or investor is you have to be consistent in your strategy. Section 5, profit taking. Here's the problem. You got good entries, but you got poor exits. Inconsistent results. That's what that leads to. Many traders get the entry right, buying fear, all that, but fail on the exit. They either take profits too early or hold too long and give them all back. This creates inconsistent results even with good setups. Profit taking is just as important as entry, if not more. An example, positive 3R, unrealized, it closes at 1R, realized. That is poor management. That is poor management. This is why we have our structured trade already laid out even before we enter. And everybody taking the advanced course knows this by now.
Hey, Dave, I got a question.
Yeah.
You talk about stop losses. Where should that be at?
That is a 5-hour to 10-hour long conversation. So, okay. Yeah, that's not an easy thing. So, again, I think that a lot of you guys here, let me actually do this now since we're close to being done. Here's what I want everybody to do. I'm putting my email. If you're not in touch with me, you don't have my email. I'm putting it in the chat right now. I'll put it on YouTube too. I want you to all email me like right now. If you have these sorts of questions, I can work with you one-on-one. And I think that if you're serious about being, I'm putting it in the YouTube chat too. I think if you're really serious about this, guys, like you need, like this is something you have to cover. So email me, we can set this up one-on-one. Also, again, I want to be clear. There's over 200 hours of instruction on the advanced trading course. Make that investment. I work with you one-on-one. If you purchase the course, I work with you one-on-one. You're not going to, I hold your hand the entire time. It's 6 months, roughly. So it's not a short period of time. Okay. But I'm telling you, if you guys are serious, okay, and you want to work with me and you want to become profitable and understand a strategy that works, you guys got to work with somebody. If it's not me, work with somebody else. The whole point of these things, the whole point of me doing this is I don't want you to waste 8 years of your life and a whole bunch of money making the same mistakes I made, right? I want you to avoid that. That's why I do these Sunday calls for free. Because I think if we touch the basics, you can get a good idea, but still execution comes down to everything, right? So reach out to me, email me, get this done right now, and we can work something out. So yeah, as regards to how that works, it's a long, long conversation. So send me an email, we can set that up. So your target logic, guys, is liquidity equals your destination. Structure defines the targets. Price moves toward liquidity, not randomly. This market is not random. This is why we can understand certain zones and targets. This is why we have some certain accumulation zones and take profit zones. This means your target should always be based on where liquidity exists. Understanding this gives you a clear roadmap for the trade. Without a defined target, you are just simply guessing. An example, equal highs equals a target. Let me ask you guys a question. Are we taking profits when we revisit 126 whenever we do 126K, or are we buying that zone? Somebody answer.
Taking a profit.
Why?
Because it's probably going to reject and come back down.
Why?
Because it's a resistance, major resistance.
Exactly. Exactly.
All right.
Exactly. Well said.
Yeah.
If
I learned a lot from you, Dave.
Appreciate you. If we revisit 51, are we buying or selling that zone?
I can answer, but I'll
Please.
let someone else.
No, go ahead.
All right, we're going to buy it because it's a support.
That's right. And it's a high liquidity zone. Right? These are our target logic. This is the logic behind a target. Scaling model.
Dave, first,
go ahead.
You said you're buying. Is that just on Bitcoin or you mean any coin?
at 126?
That's a good question.
No, we're selling at 126.
I meant
We're not.
selling. I didn't mean buying.
So
Sorry.
when it comes to the altcoin market, right? We kind of just went over what the altcoin market does depending on what Bitcoin is doing, right? I think we'll have to readjust or at least analyze what the altcoin market is doing when Bitcoin hits 126. That's not as simple as just saying we should sell our altcoins, because a lot of altcoins might still be in accumulation at that time. A lot of altcoins might have been put in a 10x already at that time. We don't know. But what we do know is if Bitcoin is getting rejected at a high time frame resistance zone and it's not consolidating upon rejection, likely altcoins are going to take a shit. So it really just depends on the environment that we are currently in. Here's what I can tell you. If altcoins are not outperforming Bitcoin on the Bitcoin dominance chart and the altcoin dominance chart, when Bitcoin is at 126, we're still risk off. Period. Full stop. We should be basing our altcoin model on what environment Bitcoin is in. So a good example of that is really simple. If Bitcoin is in price discovery, typically altcoins are still not outperforming Bitcoin. If Bitcoin is in price discovery and consolidating, typically altcoins are outperforming Bitcoin. It depends on what Bitcoin's reaction is at the time of breaking these key levels. That's what we're waiting on. So we don't know yet. We'll have to wait and see. If you're trading altcoins, just remember your risk is magnified. It's a leverage play on Bitcoin. So make sure you're taking profits, because if we get a strong rejection at 126 for Bitcoin, your altcoins are going to take a shit. So lock profits. Trading altcoins, guys, is extremely difficult. Accumulating altcoins is relatively easy. All right, dollar cost averaging, having spot positions, that's relatively simple. But if you're trading with leverage altcoins, I actually recommend you don't. I recommend you just trade leverage on Bitcoin. And if you're trading leverage, have a large position in small leverage, small margin. 2, 3, 4, 5x. 7x if you're feeling frisky. The days of using 20, 50, 100x, like that's done. If you're using that kind of leverage, you're working against yourself. You're hurting yourself. So just remember the rules we're kind of going over, right? We don't know what altcoins are going to do. We were in price discovery for Bitcoin for a year and a half, 2 years, and altcoins never outperformed Bitcoin, not once, in a sustained way. That should tell you everything you need to know. You would have been better holding just Bitcoin than any altcoin, pretty much. So think about that. Think about that moving forward. Understand your risk, right? This is why this is complicated and there's nuances here. It's not simple. It's not simple. But again, if you're trading, you must manage your risk. You must know when the trade is invalid. You must know where your stop losses should be and when to cut your trades. You must, or else you're going to round trip. Round tripping trades too. I mean, that happens all the time. How many of you guys have traded altcoins or any trade and not even had a stop loss? Like, you don't need to answer that, but just ask yourself, have I entered a trade with no stop loss before? If the answer to that is yes, like, you gotta change that. You gotta change that. If you've entered a trade and you didn't know exactly where your take profit levels were, you gotta change that. Like, you cannot any longer move forward on trading and not have these levels mapped out and understanding why these levels are where they are. That ends today. If you're not comfortable figuring that out, like I said, I can work with you, but at the end of the day, just don't trade. Invest. You have to know these things. Okay. When we are taking partial profits, the whole point of taking partial profits is you're locking in the gains, right? No one has ever gone broke taking profits, guys. They might not have gotten rich quick, but they haven't gone broke, right? And this is a marathon, not a sprint. Okay. This creates the balance between consistency and opportunity. It removes pressure from decision making. The reason we have these levels mapped out and we have them set, we set them and forget them, is because I'm not looking at the chart every day. I don't want to be looking at the chart and making emotional decisions. Oh my God, the trade is moving against me. That's fine. I have my stop loss in place. I know exactly how much my risk is. I don't care if the market moves against me. I know where my trade becomes invalid. That's why I have my stop loss. You can't win every trade. You lose one, you move on. That's it. When you're trading, you should not be looking at the charts. Now, I also want to make that a rule. No more looking at the charts when you're trading. You have your risk mapped out. You know where your stop loss is. You know your risk to reward. You know your position size, and you know where your take profit levels are. That's all. It's like I always say this when, as a server back in the day, when I would set a table, I set the table, I set it, and I forget it. Why? Because I know there's going to be a new customer coming in to sit at the table. I just set it and forget it. I know what's going to happen. There's no point in me watching the table. Same thing here. There's a trade filter, and this is really important. If there's no target, this is what we were just talking about, there's no trade. If there's no target, there is no trade. If you have poor risk reward, you skip the trade. Poor risk reward is 1R. If you're risking your entire position size as far as your profit goes, you skip the trade. You're not going to bet 50 to make 50. Those days are done. If you cannot clearly define where price is going, you should not take the trade. A good trade always has a clear target and a favorable risk to reward. This filter alone removes many low quality setups. Discipline improves performance. No clear target, random outcome, skip the trade. Extraction is better than prediction. Consistency over perfection. You don't need to catch the exact top or bottom to be profitable. Your goal is to consistently extract a portion of the move. Focusing on prediction leads to inconsistency, while focusing on extraction builds reliability. This is how professionals operate, right? An example, catch the middle of the move, consistent. No need for extremes. This is why we have taking partial profit levels. Altcoin selection. Charts versus the fundamentals, guys. Gone are the days of, well, this project has the best fundamentals, but the charts look like shit, so I'm going to take the trade anyway. That's crazy. That's crazy talk. Fundamentals equal what? Charts equal when. Fundamentals and charts serve different purposes and should not be mixed. Fundamentals help you decide what to trade, while charts help you decide when to trade it. Keeping these roles separate improves clarity and execution. Mixing them leads to confusion. So a strong narrative plus a bad entry is a loss. Timing still matters here. What matters in terms of that? Fundamentals and the charts? Well, what's the narrative? Where's the liquidity? And what's the relative strength against Bitcoin? This is why we look at altcoin Bitcoin pairs, right? I don't want you to look at XRP USD anymore. I want you to look at XRP Bitcoin. I don't want you to look at Solana USD anymore. I want you to look at Solana Bitcoin. Altcoins move based on attention and participation. Strong narratives attract capital, liquidity allows movement, and relative strength shows leadership. Without these factors, price action is weak and unreliable. These are your filters for selection. So if there's no volume in a certain project, there's no move. Attention drives the price. People always ask the question, when is retail going to come back? When the price is higher. When's the narrative going to change for AI to deepen, to RWA, to gaming, whatever the case may be? When the price action says it should. That's it. Simple as that.
Dave,
Yeah.
I'm sorry to cut you off. I don't know if this Fireflies is important for you, but they said that they stopped recording.
No, it's all good.
I just figured they, it says you can re-invite for them to record. I thought that you might want to know.
No, I
Sorry for
appreciate
cutting
it.
you off.
No, we're good. We're good. So the framework is, guys, you pick the fundamentals, you enter on the technicals, right? You pick the fundamentals. If we're trading Ondo and we like Ondo because it's now partnering with Franklin Templeton, okay, it's on our radar, right? Maybe it's a good long-term spot position. Sure. But we enter on the chart structure. When does the chart structure shift? We are catching the momentum moves. If you are accumulating the bottom of certain strong fundamental projects, just understand that it might take a while before the chart actually moves in your favor, if ever, right? So timing is everything here. Separating selection from execution simplifies your process. You choose assets based on narrative and liquidity. Then time your entries using the structure. This prevents emotional decisions and keeps your strategy consistent. It creates a clear workflow. Good coin plus bad timing equals a loss. A lot of people have been saying, maybe it's a good time to accumulate Say. Well, let's look at that in practice here, because I think Say is a great project, and I also would like to accumulate Say. But let's look. I want you guys to tell me, is this a good time to accumulate Say? And I'm picking on Say here because I think it's one of those projects that have strong fundamentals, but the price is fucking weak.
I feel like you're attacking me.
I am attacking you. Am I accumulating?
Bitcoin changes structure.
Not until Bitcoin changes structure, absolutely. But let's just focus on Say structure in general. Am I accumulating this project even though it's strong fundamentals?
Yes.
I mean, look at this.
No.
Absolutely not. Now, the structure could shift. And Tari, I'm not picking on you because me and you both like Say, but I think this is a great example. I mean, it's a wonderful example. Until structure shifts, right? Higher highs, higher lows with acceptance above some sort of important level, we're not accumulating Say. I don't care how strong the fundamentals are. It doesn't matter. The chart looks like shit. Here's a good example.
Don't get
You can buy my bag though, David.
Maybe I will. Tau, great example. Strong fundamentals, strong current narrative. What's market structure telling us about Tau right now?
It's still in a downtrend, but it looks like it's reversing. It looks like we're about to make a
starting to reverse. Yes, it's a good
inverse head and shoulder.
It's a good project to think about accumulating as strong fundamentals plus the chart looks good. Now, if I were to accumulate Say or Tau, I probably am not going to accumulate this breakout, right? We don't buy breakouts, guys. It's what we were talking about today, right? We don't buy breakouts. But what we can do is we can buy market structure shift confirmation. We would accumulate here. This is where we would accumulate. We're not accumulating here. We're accumulating on the back test. If we don't get the back test, we skip the trade. Understand?
What about the FVG at that time?
Say again.
What about the FVG at that time? The fair value gap, because you can wait until gold pockets on the fair value gap and then on the retrace and then up to the upside.
Yeah. What I would do is I would accumulate both those levels. You're right. You're right for saying that.
Sweet.
Yep. Good point.
I mean, what I see here is the volume is supported too as well.
Yes, exactly. Right.
Cool.
Right. So you're right to say this. This is the weekly time frame. Let's go to like the daily. Maybe we can see it a little bit easier. So you're absolutely right. I'd probably accumulate this level, the breakout zone on the back test. If we fail to hold, I would probably accumulate this zone too. If we fail to hold, assuming the narrative stays the same, I would accumulate the full fill of the fair value gap. So I'd have 3 entry levels. Well said. Well said. Okay, good. We're almost done with the slides. So let's finish that up and then we'll do some questions. 12:05. We got some time. We got some time. All right. So you pick the projects you like based on the fundamentals. You enter based on the technicals, right? Separating selection. Screen got in the way. Separating selection from execution simplifies your process. We want to keep this as simple as possible. You choose assets based on narrative and liquidity, then time your entries based on the structure. We just looked at both. This prevents emotional decisions and keeps your strategy consistent. It creates a clear workflow. Risk adjustment. You must have, and this is when you increase your risk, a clear trend, confirmation, and alignment. You increase risk when multiple factors align in your favor, confluence in your favor. This includes clear direction, strong confirmation, and stable conditions. In these moments, probability is higher and you want to take advantage of it. This is where you make most of your returns. Clear trend, larger position, that's a press advantage. Reducing your risk, chop, conflict between the charts, high time frame, low time frame. What is Bitcoin doing? Volatility. You reduce risk when the market becomes unclear or unstable. Simple as that. Conflicting signals and volatile conditions increase your uncertainty. In these moments, protecting your capital is more important than making profit. Let me say it again. In these moments, protecting your capital is more important than making a profit. Patience becomes your edge. We are waiting for the retraces. We are waiting for the shift in structure. We are waiting for a high liquidity environment. Messy charts, no trade. Preserve your capital. Risk is dynamic. Adjust constantly. Risk is not something you set once. It's something you constantly, it's something that you constantly adjust. Professionals adapt to market conditions, while most traders stay static. This is the difference in this difference is what creates consistency over time. Flexibility is part of your edge. Being able to flip your bias is your edge. Trading versus investing. This is kind of the last little topic of today. Trading is short term, guys. It is structured. You have defined risk. Trading is a structured process with defined rules, period. You know your entry, you know your stop, you know your target before you enter the trade. Let's say this again. You know your entry, you know your stop, and you know your target before you click buy or sell. It is focused on execution and precision. There's no guessing here. We know exactly what's going to happen. We set it and we forget it. Investing. This is long-term. It is thesis-driven. We accumulated accumulation zones. Investing is based on a broader thesis and a longer time frame, years, maybe in some cases 6 months. You are building a position over time rather than timing exact entries, right? We're not sniping those levels. We're accumulating those levels. This is why we've been accumulating Bitcoin ever since we hit 61K. If we go down lower, we accumulate more. If we go down lower, we accumulate more. It requires patience and conviction. Precision matters less than consistency here, guys. Buy over time and hold. No short-term exits here. If you're buying and exiting within a week, a day, maybe a month, you're trading. You got to accept that. And if you're trading, you got to follow the rules. The mistake here, guys, is mixing strategies. making emotional decisions. Most traders fail because they mix trading and investing, period. They hold losing trades like investments and trade investments like short-term positions. This creates confusion and inconsistency. Keeping them separate is critical. Trade goes red, I'll hold it. It becomes an unintended investment. The rule here, guys, trading is execution, right? Sniping, so to speak. Investing is conviction. I'm investing in Bitcoin because I believe it'll go up over time, and I believe it'll be the backbone of the new financial system at one point or another. Trading and investing require completely different mindsets. One is based on precision and structure. The other is belief and patience. Mixing them leads to poor decisions in both. Clarity between the two improves results. Trade plan versus long-term thesis. Those are different frameworks. Final system here. Risk, Bitcoin, liquidity, entry, exit. This is your full order of operations, how everything connects. You start with risk, then evaluate the environment, then look for liquidity and structure. Only after that do you execute and manage the trade. Skipping steps reduces probabilities, right? And the whole point is we want our expectancy to be high. Example, jump to entry, fail. You didn't do anything else. You didn't set your stops. You don't know where the liquidity zones are. You failed the sequence. The truth is, guys, no trade is better than a bad trade. Patience is your edge. One of the hardest lessons in trading is learning to not trade. You don't need more trades. You need better ones. Avoiding bad trades protects capital and improves long-term performance. Patience, guys, is your edge here. Patience and having a system is your edge. Skip a trade, avoid a loss. That's the same thing as having profit. Find when risk is rewarded, not just the trades. You're not trying to find trades. You are trying to find the moment where risk is actually worth taking. Once you understand this, everything else becomes so much easier. Stop forcing trades and start operating with clarity. That's the real shift here. Wait for the conditions, take fewer trades, and have better results. Bang. And that's going to end our Sunday PowerPoint slide here. Let's spend some time talking about questions. Let's spend some time looking at the charts. Any questions on kind of the things we went through today?
Yeah, hey Dave, what's a good way to effectively avoid fake outs? That seems to be my issue.
Yeah. So a good way to effectively avoid a fake out is you're waiting for acceptance. You have to wait for a certain structural level, support or resistance zones, to be accepted. That's it. So
does accepted is equivalent to retest?
Yes, exactly.
Okay.
And a successful retest. And not only a retest, but what sort of reaction are you getting on that retest? So a good way of saying that is, are we gaining acceptance above a certain level and holding it, right? So what we would need to see, let me get rid of this MA here, just as the most recent price action, we could even move this down a little bit. Let's do that. It's more, there we go. These are liquidity grabs. We know that. Why are they liquidity grabs? Because they didn't gain acceptance and hold. We would need to see a strong reaction on a retest for us to assume any sort of acceptance. So if we were to gain this level, breaking out of the range, having high volume coming in with a strong candle of displacement to the upside, sequence of candles to the upside, that's likely acceptance above a level. Just sweeping a level and staying there for a few days is weak. Sweeping a level and staying there for a day, weak. Sweeping a level and staying there for a day, 2, extremely weak. We would want to see a candle go like this. We would want to see a high volume candle, high acceptance candle, high bodied candle, gain acceptance. That's our first indicator we might be gaining acceptance. Wait for the retest and hold it with another strong reaction. That's your confirmation.
Appreciate that.
Hey Dave, do you use a lot of Fibonacci at all, like in the reaction zones?
Yeah,
Does that help
on high time frames, not on low time frames.
Right on.
Yeah, fibs are really, really good for reversals and continuations on high time frames. They're good on low time frames, but I don't think you need them. I just think you need to know structure and liquidity. Personally. There's a time and place for fibs. There is. Remember the golden pocket. Remember that in a continuation market, we'll retrace to the golden pocket, both to the upside and downside. That's your entry point if you're going to use it. If we don't retrace, you wait. Good question. Yeah, fibs are important. Don't get me wrong, but they're not everything. You should be using indicators like momentum indicators while you use fibs, right? If we're retracing to the 618 and the RSI is even close to oversold, it's probably not going to hold. Like, these things matter, right? Confluence. And the higher the time frame, the more confident you can be in the confluence. This is why trading on the 1 hour and below is super hard. It's hard, man. And you should be in and out of a trade. If you're trading below the 1 hour, you should be in and out of a trade in a day. If you're trading on the 4 hour, maybe a day and a half, 2, 3, maybe. The daily, a week, maybe 2. Weekly, you can hold it for a few weeks to a month, maybe 2. Again, depending on your style, right? You need to know the lane you're in. This is where it also becomes like practice makes perfect. You just got to figure out what works for you. What works for me might not work for you. That's okay. Doesn't change the risk structure though. Your risk management is going to be the same as mine. If it's not, you're not doing it right, you know? So you just got to pick your lane and follow the strategy in terms of risk management. Good question. Anybody else?
Hey, Dave, I have a question.
Yeah.
I feel like a toddler sitting in a college class, man. Y'all are way over my head with some of this stuff. Can you apply? Is all this can be applied to like stocks or just crypto?
Absolutely, it can be applied to stocks. In fact, it's way easier to be applied to equities. If you can trade crypto, brother, you can trade anything. And don't worry about it being over your head, man. This takes so much time. It takes practice and it takes consistency, dude. So pick up what you can today, leave the rest. You know, rewatch these videos, do your own research, talk to me about it, talk to other people in the community about it.
All right. Speaking of the stocks, what do you think of the CLU trade, the long oil still?
Oh, I think you're dead.
Really? To 125 a barrel or something?
I would not be longing oil here. Maybe I'd be scalping oil here, but I would not.
Right.
Be, yeah, I would not be like holding a long position here. No way.
Yeah.
Cool. I wouldn't. I mean, like it was like longing gold at 5,000. I was like, I wouldn't do that. You know,
I've been sitting in a long oil trade for a little bit now, so it's been going up and down, but it's still it's
I mean,
high
look,
now. But I still have expectations of like 125 a barrel maybe or something. You know?
yeah, I mean, again, I think like you just need to understand your risk and know your exits.
Right.
And why? I mean, it's not a bad trade if you have good risk management. I just think that like there's such things as called a crowded trade, right? And like everybody thinks oil's going to go up. Usually it doesn't. Right? Usually crowded trades end in a bad way. But I'm not saying you shouldn't do it. All I'm saying is if you do, know your risk and when to exit. Like have it mapped out, right?
Yeah, I guess I need to raise my stop loss.
If you're waiting, right, have your stop loss. If you're waiting for oil to hit 125 to exit your trade, I think that's just bad management. Because it doesn't have to hit 125. Why are you picking 125? Just curious.
Just because I hear a lot of talk about with war like excavations or whatever, war escalations that I don't know, there might be a big chance of 125 a barrel when it comes to like being held in the Hormuz actually takes effect on everything. We haven't even really felt that effect yet at the pumps like that, you know?
Yeah, but
if it does start happening like that, I can see the barrels getting up to being high like that.
For sure, but you answered your own question. You're only having that target because you hear about it. It's not a technical target.
Totally.
Which again is like, okay, if it's what the consensus is, how often does the consensus play out?
Totally never.
Never. Well, not never, but rarely. Right? And so what I would
Trump
do
talks about it.
So what I would do if I were you, I would have other levels of take profits before 125 and exit at 125 if we ever hit it. Right?
Yes,
but don't have your whole position be exited at 125. I wouldn't do that.
Thank you for the advice.
Yeah, no problem. The oil trade, dude. Yeah, I mean that's something else, isn't it? Let's look at the oil chart. Yeah, I mean, look, like what do we see on the chart right here? We're coming up against resistance. Is this a good place to long, or is this a good place to long? Are we taking a trade here?
No.
Right.
Not unless you've been in it for a while and it's been like in a range and you're still consolidating until it breaks going down. You know?
A good trade would have been here. Right? Your risk to reward trade, right, that we were talking about, would have been good here on this breakout.
Totally.
You know, you could be more generous and put it here. Where we had our gap. You know, that would have been a good trade, good breakout trade. But I would not be entering along here. If I'm entering along, what I'm waiting for is I'm waiting for the imbalance to fill. Then I'd come back on the successful retest. Then I'd maybe enter. If anything, honestly, I'm taking a short here, probably. But again, like you got to look at the big picture. Should I short that even though the chart looks good? No, because the narrative is opposite of the chart. The narrative is oil's going to go up. So maybe I shouldn't short that either. A good trade in this position is no trade at all. When would I take a short? When the narrative shifts. War is winding down. No boots on the ground. Iran's capitulating. Oil starts to drop and back through this support zone. We gain some acceptance. We have a nice little bounce because people are still unsure. Narrative aligns with the chart. Then I'll take the trade. But right now, a long trade does not align with the chart and the narrative. Not today. That could change tomorrow. We don't know. It could change. But today, no. Who else got questions?
Yeah, I had to step away for a minute. Did you look at S&P? Because I wasn't sure. I had to step away for a minute.
No, let's look at that real quick. So we've been talking about the S&P rolling over for a while, right? We have. We've been talking about this, I don't know, for like 3-4 months.
Yep.
Does anybody want to talk about what, like, kind of guess on why I thought the rollover would happen?
Because it
Like,
broke that.
or maybe a better question is, like, what do you got? Did you guys expect this rollover? Like, why?
It's toppy.
Yeah, I mean, what about it looks toppy?
Okay, so basically you can see how fast it's going up, and then you can see how it kind of slows down, and then it goes into like this little range, and then it kind of fell apart. So I guess I don't know if that's the best way to describe it.
You're spot on. I would agree. What is this? Does anybody know what this pattern is called in technical terms? Does anybody know what this is called?
Is that Adam and Eve?
No.
Golden arch.
No. It starts with an R. Not an Adam and Eve. That's a bullish reversal typically.
Oh, okay.
We actually have an Adam and Eve right now on Bitcoin or on Ethereum. Besides the point.
You're gonna say it, and I'm gonna be like, "Oh yeah, that's right," but I'm completely up for a loss right now.
It's a rounded top.
Rounded top. Oh, I would have got that.
Right? It's a rounded top. Right? So these are very typical of slow rollover, bulls losing control, typical consolidation, failed breaks of all-time high. That's a rounded top. Those are very, very, very often reversals. Way more often than not. Way more often than not. And then we talk about, okay, well, what's our target? What's our technical levels here? Well, we already broke through one. And
I
notice
haven't looked at this chart in like a week, and this looks horrible right now. Wow.
Yeah, it looks bad right now. It does. It looks bad right now, for sure, 100%. Right? But look what happened after we broke, finally, our level of support. What happened? We had a gap and a large move. Continuation. Right? This is a large move. A gap plus a nice body candle for the S&P. That's a big move. That's a big signal. Okay? That probably means we're going to come revisit this next level. Breakout level. Price loves to trade to the breakout level. You know what else it loves to trade to? It loves to trade to the 0.5, and it loves to trade to the 0.382, which aligns perfectly with our breakout level. Likely, guys, as of today, we're going to see something like this. If we break the 0.5, it is highly likely we'll bounce at the 0.618. Highly likely. Highly likely. Very, very, it's very, very rare that the S&P will break, or any major index will break the 0.618. It's super rare. If we do, we're in a recession.
What's the time frame on that?
This is on the daily time frame.
Hey Dave, I'm just curious. Actually, you're doing it right now. I was gonna ask, where do we go to on the last? That's, you read my mind. That's exactly what
level is that? What level is that?
618. Respecting the TA exactly.
Look at how strong the reversal was.
That's funny because I was just gonna ask how that was on the last dip we had in last April. That's amazing. So yeah, history shows it's probably gonna hit the 618 and bounce right back.
Yeah, I mean, if we break the 0.382 or 0.5, it's almost 100%. I can guarantee it. But here's the other thing too, though. High time frame support. Like, don't discount this level of breakout zone before we had our previous correction. That cannot be discounted. That's an important level.
And what did that line up to? The 0.5? Was that what did that level line up to the? I thought it was. I don't remember. I think it was the 0.5. No, 382.
382, which is a strong reversal. which is a strong reversal zone in a secular bull market.
This stuff intrigues me. I love it.
If we don't hold the 382, how I view it is this. Maybe we're heading towards a recession. If we don't hold the 0.5, we're going to hit the 0.618. If we do not hold the 0.618, expect a year or two long bear market. If we hit the 0.618 and don't hold it, expect the Fed to step in.
What do you do in a year long or 2 year long bear market?
What am I doing? I'm accumulating the lows. I'm accumulating. S&P goes up over time. I mean, it's possible that we could have like a period where back in, I think, the early 2000s, I think it was, or 90s. Let me check. This is the weekly time frame. We had a period of kind of a ranging market in 2018 to 2020. So that was like a 2-year ranging market. We made some highs. We also made new lows. That's considered a ranging market, no structure, right? And then we also had a period here, which we still had good returns, but we didn't break new highs from 2000 to, well, really until 2013. I mean, this is a painful market right here. We do not want this to happen. Right? This is pain. This is a lot of fucking pain. I would still be buying the retracement levels and maybe selling the tops, right? We're going to be buying support, selling resistance. You can make money that way. But like, you know, that's painful. I don't think that's going to happen. I think that the way our monetary system is working now, in terms of how much debt we have, how much we have to refinance, because of the deflationary aspect of AI and robotics and all of these things, plus a monetary war between Russia, China, and the US, we're gonna print into oblivion, guys. Like our money is gonna become so fucking worthless in the next 10 years. It's not even funny. They can't slow down inflation. Trueflation is saying that we're slowing down, but CPI is telling a very different story. And they're not going to raise rates. If they do, they're going to break the economy, and then they're going to have to just cut crazy. Like we're in a really shitty situation. This is why oil has to go down.
But Dave, what if we start this is like a complete hypothetical thing, but for the US dollar, wouldn't, like, now we're taking over Venezuela, right? We taking over Iran. Now, what if we make both of them use our stable coins, like this whole stable coin, instead of using their own currency, which has both failed? If they start using our money instead, wouldn't that be good for the US dollar? Wouldn't that make the US dollar stronger, that they're buying our debt?
Yeah, for sure. Part of that, though, is that that trade is already settled in US dollars anyway, globally, right? This is why China is such a this is why the China situation is such a big deal, because if countries start to settle trade in the yuan, then the value of the dollar will definitely go down. We have to have a strong dollar.
That's my theory for the whole war in Iran. I don't think it's all about nuclear. I think it was all about oil and how they're settling it.
100%. I mean, it's multifaceted. I can tell you from someone who like is intimately involved in this. It's definitely about terror. It's about nuclear. It's about oil. It's about China.
Mm-hmm.
You know, it's multifaceted. But yes, the reason stablecoins are so important here, and the reason why the Clarity Act is likely not going to include rewards on deposits, is because we have to have a strong treasury market, guys. Don't worry so much about the getting rewards on stablecoins. It sucks. It's whatever. But we need stablecoins to be the backbone of the new financial economy. We need the digital dollar to be used. We have to.
But I wasn't talking about I wasn't talking about them settling the oil. I was talking about them using it in their own economies. They
already do. They already do.
All right. Yeah, because their currency went.
When I was in South America this summer, I was in Peru and all that. They wanted dollars. They have their own currency, but they wanted dollars. When you go to Europe, you could use the euro, but they'll take merchants love taking credit in US dollars. When you go to Israel, same thing. They want US dollars. When you go to India, same thing, US dollar. Everywhere I've ever been, they want US dollars.
That's amazing for crypto because stable coins, it's going to be huge.
Yeah. This is why it's important. I can tell you right now, countries in like third world countries, African countries, some South American countries, some Asian countries, they are already using stable coins, USDC. They want stable coins.
The new financial system, that's awesome.
Yeah. Any other questions here, guys? We've been on for 2.5 hours. Should probably get off soon.
What color are your socks today, Dave?
What'd you say?
What color are your socks today, Dave?
What color are my socks? I'm barefoot.
Nice. Earthing. Grounded.
Getting ready to touch some grass.
That's right. All right. My girlfriend's going to get mad at me if I'm not off soon, so I should go. But this was great, guys. We're going to do this every Sunday. I'm going to throw this up on the YouTube. Like I said, email me. Like if you guys are serious about trading, investing, hit me up. The courses are still going on. We can do one-on-one time. I can send you information. There's a whole bunch of things we can do. All right. Don't do this by yourself, though. Stay in touch with people in the community who have been in these courses or know what they're doing. They are also a really big help. I'll see you next Sunday. And yeah, guys, absolutely. Have a good week.
You too, brother.
And same time next Sunday, we'll be here.
You got it.
All right, guys.
All right, thank you, Nate.
Take care.
Thank you, legend.